Hey traders, Raghee here, and we're going to talk about crude oil in this video. But before we jump into the chart, let's talk about where the setup for today's crude oil trade started from. And it's something that we can actually do every single week. And that starts with the crude oil inventories number that's released at 10:30. So this particular time is when we look for the setup and not a moment before. There's two ways you can look at setups in front of what I call hot zones. Those are those volatility events that are on the calendar. We know they're coming. The market knows they're coming, and the market can discount or prepare for them. Now, there's a pre-setup. A lot of folks like to be pre-positioned. In other words, they want to make a bet on what this number is going to come out as, and then they'll be pre-positioned based on their hunch, their bet, their analysis, whatever. There's another way to do it, and this is the way that I prefer, and that's post. In other words, let the event happen. Let the market scramble to either congratulate itself for having bet the right way or have to adjust for having not bet the right way. And I prefer the post event. So it all starts with a hot zone, a scheduled event where we know volatility is going to hit a particular market. In this case, crude oil. It's all about the CL contract. Okay, so that's where it starts. So this is something we can prepare for every week. The setup is not valid until 10:30. So as you know, for our purposes here, the only thing that I'm interested in before 10:30 are what are the volatility ranges for this market. So between 10 and 11 o'clock, so this is really what I'm looking at between 10 and 11. It's the 60-minute hourly price movement range. Now, I created this calculation based on some data from my dear friends at Auto Chartist many years ago in the Forex markets, about 7-8 years ago now. And this is based on breaking a market down into the 24-hour, 1-hour segments, and then looking at the typical price movement range for each one of those hours of the day. And based on time and based on volatility, you can project a resistance level and a support level. So now that I have data for this in many markets, we can use this volatility-based support and resistance. It's something I created, and I just simply call it the HPMR, the hourly price movement range. So the idea is basically what I call first come, first serve. And that means whichever way after the event the market reacts and responds, up or down, if it can get up to that resistance or support, we have a play. And so what we ended up doing about 3 minutes after the number came out, the volatility struck, is we got up into this resistance zone. And up in the resistance zone, we have a short sell. And that was it. That's first come, first serve. Where do we go first? And then not always am I looking for the market to go to the other side. Right? I think that's probably a pretty common error. This might be a second profit target. This might even be a third profit target. But the initial target was right up in here. And so this ends up being one. And then, this ends up being the second target to the downside. Now, a lot of folks will ask, can we look to the long side? And that's fine. We can talk more about that in the premium video. How do you set this up? Is there a buy here? And how would we do this? But let's start with where this all begins. This is where it begins. Okay? Using volatility, using time, and using the hot zone. So think about that with different events on the calendar. This has been a blueprint that I've used for many decades, and we can sharpen up the zone that we can expect the market to exhaust from by using its typical ranges, its typical characteristics, its typical price movement. And this is what first come, first serve is all about. I'll see you in the next update.